Good afternoon, good morning, uh, Clueless 8 trading members, everyone who's going to be hearing this weekend update. Welcome to a quick weekend broadcast with some very important pointers coming into the Thanksgiving week and the end of the month. This session will be recorded and uploaded to the YouTube channel for free viewing by all Clueless 8 trading members. Today is November 19th, 2017, approximately 10:32 a.m. Eastern Standard Time. And let us begin. Full disclosure, this is purely for financial education and not for any solicitation or advice. And let us begin. First of all, what you see behind you is a picture of the overall market going back to 2015. Forget 2015. Let's focus on from February of 2016, right there. All right, where we created a significant double bottom low, which is still holding. These are extremely powerful pivotal points in the market. And there was two other lows which were created back on August of 2015 and September of 2015. And for all of you who use Thinkorswim, and all of you who know how to look at a screen, you can see the dates up here and all the parameters and the values as I'm moving the cursor around. Bottom line is these four lows created a significant bottom in the market, as you can see, and this is where we are right now and possibly where we're going. I have constructed the chart like I always do, and I've always said, very, very importantly, from a technical standpoint, that charts in general don't lie. Humans do. That's in our genes. Our emotional cognitive bias as to whether we think markets are going up or down, sideways, or it's going to be terrible and everything's going to fall apart, and that little demons in your head which keep on saying you're going to constantly lose money, despite the fact that you have opportune multiple times to make significant amounts of money, that little voice in your head keeps you from doing that. That's standard procedure. It's also in our genes, human genes. Our brains are actually designed, and I didn't make this up, for failure, period. So you have to basically fight it in order to win. That's why we have the term, the Darwinian term of fight or flight. If you fight the markets in an effective, strategic manner, not just randomly throw punches, okay? And then you will overall win. And that overall part is what really matters. Whether you lose 3, 4, 5 trades, those 2 or 3, or those 5 or 6, or let's say those 2 or 3 other trades, which go up 4,000% or 400%, make up the significant difference between the few losses that you have. That's the way traders have to be programmed. That's the reason why I put out one of the strongest tweets out there about the Marines, which I mentioned. I have friends who are in the Marines and on much higher levels, the SEAL side, who constantly strive to perform despite setbacks. So that's trading too. You don't need to be a killer with a gun to prove that you're great, or a big boy with a gun. You got to mentally train. And what we do as traders, and I mean this because I go through it every single day, and I have gone through it for years, and I have taken substantial hits, believe me, is that very few make it as successful professional traders. You want to make quick money on the side here and there? My service is offering alerts right, left, and center, kingdom come. You want to make substantial money on a consistent basis in between hits, then you have to learn the skills. You have to really, really push it hard. Very few make it. Just letting you know. So for this game of tactical trading, and tactical trading in extreme volatile markets, and you can certainly see the volatilities, because you think you guys get worried, we all get worried, like, because of these little drops. I mean, because of these big drops? No. We start squirming like little rats and lemmings. Well, most others do more so than Clueless A Trading members and traders. And I certainly don't. On these little minor, and this is a weekly chart, so each of these bars are 1 week, right? On these little 1 week movements down, people start calling for a bear market. So you have to accept these facts. Once you accept the truth, you shall be set free. I mean it. And that truth is hard because it flies in the face and hits us, bam, just like that. Because we don't want to hear bad things, and I am the ultimate bad things about ourselves, but I'll tell you one thing. I am the master of self-criticism. Believe me when I tell you. I self-critique myself to the point where I get angry because I didn't get this trade, or I sold a little bit too early, or I didn't stay with that, or I did this and this wrong. I am in a state of perpetual improvement. I'm not reading from a script. This is not an evangelical sermon. This is what a trader does. Sob stories, I've heard every single one of them. I'll tell you more sob stories about me. You could go crawl under a couch and not come out, okay? We don't believe in sob stories. We believe in self-criticism, constant improvement, constantly fighting to get that next trade that brings us that 4,000 and God knows 20,000%. Have I not shown that? I have shown that multiple times. No one can back up from it because everything that I do is on the real-time Twitter feed at Clueless8RT, Clueless8 Trading. Members know that. Other people who are going to listen to it will know that. It's all there. I don't go around deleting things to make myself look good. So guys, it's time to wake up. All right? A more substantial portion of the advanced coaching session is for tonight, for paid students and for some invited guests. And that's at 8 p.m. Sunday, Eastern Standard Time. And I will get into the nitty-gritty of the overall technical picture. And as I always do, for people pay for 1 hour sessions a pittance of a price, what they wouldn't be paying the dog walker sometimes in New York City, to be honest with you. Okay, it's a fact. So bottom line is, it will run probably 90 minutes, and that's tonight at 8 p.m. This particular quick weekend update, I'm going to scroll through a bunch of things, give the broader picture, show a couple of charts, end the story. You want to get into the nitty-gritty of it, and I will spend hours and hours, and all of you know that. Hours and hours working with you guys as much as I can. For that, sign up for the advanced coaching session. It's under members content. Get the 5-session pack. See the difference it makes to your trading. Well, that's my short marketing pitch. That's it. All right. So on that note, let's move on. So we created a substantial double bottom, and the market basically is here. Now, the thing that I do, which I do very effectively, and I will certainly take credit for that. All right. There are deficiencies that I need to fix, including improving the website, including throwing more performance figures on the face, so you guys can look at it every other day or every day and say, just like want to pull your few hairs that you have in your head, or if you have a lot of hair, maybe pull out a clump. Okay, all those improvements are coming. I'm working on it hard. I appreciate the time that you've given me to do version 2. I need to do that. I've tried to work with 2 developers. They all suck. It's all right. Let's move on. The bottom line is that what I do very effectively, and I will take credit for that, is structuring the charts. Extremely important. Chart structuring is what puts a picture, what we call a roadmap. Once you know the roadmap, it's easier to drive. It doesn't mean that you're not going to hit a pothole, break your front axle. Sometimes that's called a loss, a big loss, and sometimes speed up past the other cars and get to the finish line. So the structuring is extremely important. So let's look at the structuring here for a quick couple of minutes. All right, it's helpful. So we keep the broader picture in our head, because our biases of constantly feeling this is the end, this is the end, this is the top of the market, happens to me too sometimes. You get these type of big fat couple of 100-point type of drops testing the 20-week SMA. That's a big thing, testing the 20-week SMA. because that's your first border before you hit the lower channel at 2471. That's a long way off. 2471 from 2578 is roughly 100 plus points. That means it's 600 to 700 points on the Dow Jones. 600 to 700 points. They're going to be calling for Armageddon in the markets. But it means it doesn't do anything. It simply means it's at the bottom of the channel. So the structuring is key. So first of all, let me walk you through that. I don't want to deviate too much. So first of all is, why is this on this mode? Hold on. Perfect. So we have the broad market, right? Going, and it's perfect contact points. From the lows here of August 24th of 2015, and the lower channel origination point is February 8th, 2016. So two perfect contact points. I like it. The more symmetry and more exact contact points there are, 1, 2, 1, 2, okay, two major ones, then you have a roadmap. So the roadmap basically measures up to, and this is on a weekly, that means it rolls into next year, probably the middle of next year. Roadmap puts the extreme high level is 2700. 2700, that's roughly 1 second here. Remember, one S&P or E-mini, one S&P point, this is an S&P chart, not E-minis, not futures, S&P chart, is roughly about, I would say 6 Dow points. So 122 points from where we are today to the extreme upper end of the channel, if we get there. It's 122 S&P points. That's roughly 732 Dow Jones points. Without asking any questions to anyone, because most people are listening to this, this is a weekend update. We have one person, we have two people in attendance right now. If you add 732 to the current level on the Dow Jones Industrial Average that we are at, and we arrive at 24,090. Let's call it 24,000. See, round figures, 2,700, 24,000. It's not a stretch to believe we can get to 24,000. So that's the broader channel. Second channel that you're looking at is a one which is this one. Okay? And that is not that perfect a channel, to be honest with you. I tried to touch the top of each of these moves where it basically, swung lower, went above, hit it, swung lower, hugged it. And this is these two. That measures up to 2620, which is my short-term price target on the S&P 500 and has been from all the way back in middle of this year. I'm not going to say, oh, that was my price target from all the way here. Nope, it wasn't. Okay, it was mostly from April to August timeframe. That's when I started to say, you know what, we're going to see 2600. We're going to see 2600. So at this point, for tactical traders, you should be marking the 2620 level as a short-term top. Now, there is an acceleration channel in play here. You can see this one. Let me try to zoom in. And these are important because this is very, very critical, because what the broader market does is what your overall trades will do. And you won't, many of you won't be running for adult diapers, every couple of days or every couple of hours, because you know what, sort of the roadmap is. So you got two things here. You had a broad, see the dotted lines right there? This dotted line was basically a bull flag channel. Went on for months. In fact, went on for the remainder, from the beginning of 2017. Long time ago. Anyone remember beginning of 2017? It was just like, whoa. So that was this channel here. And we stayed within that channel perfectly. Then we broke out. The breakout happened. The breakout happened right here. This was the channel. You can see that. And we broke out on or about October of 2017. So this breakout that's getting played out just started in October from a technical standpoint. Right there. Right there. Before that, we're trading on this channel. I'm going to make this thicker so people can see it. Some of you who might. There you go. All right. So there was your continuous bull flag channel. Everyone freaking out, feeling good, freaking out, feeling good. You know, all kinds of stuff. Then two big blasts on in August for all different reasons, right? We know that. I'm not going to get into the reasons. Take me like 3 days, and you guys all know the reasons too, because my Twitter feed is a running history, a tactical history of the stock market. That's really what my Twitter feed is since April 15th of 2014. Seriously. So, saying all that, we broke out. So that created a acceleration channel, in my opinion. This is just the way I draw my charts. Right or wrong, it works. It works splendidly. So there's your acceleration channel. And that acceleration channel, ladies and gentlemen, we were trading in since August. You can see that right there. And the upper end of the acceleration channel is 2650. A little bit more, that's more like 800 points on the Dow. And we basically we fell out of it on the 6th, on the week of the 6th, and this is where we are right now on the 13th. The 13th ended on the week of the 13th, which ended on the 17th, right? So this was last week. So what do we see here? It is attempting through a somewhat of a bullish doji, a minor hammer reversal. You can see that right there, that glowing little green little thing, right? To enter back into the acceleration channel. If it is successful to get above 2594, which was the previous high basically, because we're very close to it, right? We're just kissing distance. Then you're going to see a fast move up. It's going to attack this line, the 26th level that I mentioned to you, 2616, 2620, and then it's going to try to get to the top of that. So given the fact that we are going into Thanksgiving week, which generally is choppy but positive, just the way this week was. It was choppy as hell between a whole bunch of our stocks going through the roof. Not even going to make any qualms about that. Want to know what the symbols are? Please go to the Twitter feed. Get a nice lead pencil, and write down each of the symbols. Look at the ones you did and did well on, and look at all the ones that you left aside. All right? Do it. And I'm not going to even mention names. So bottom line is this could be looked on as a consolidation channel, because that's really what happens, or a bull flag. And that bull flag might even resolve itself to the lower end and retest the breakout of this rolling bull channel that we were in since the beginning of the year, and that's at 2550. Now 2550 from where we closed at, ladies and gentlemen, is approximately 28 or 29 S&P points. Multiply that by roughly 6. That's 174 Dow points. Whoopee! Really scary. Now, it's a consolidation channel. But I can assure you, that's how all of you, most of you, are going to feel. You're going to hear a lot of garbage coming out of the media. You're going to hear some very powerful voices who stand their ground and are very powerful tacticians. And I always mention those names when they show up on the media. And all kinds of garbage. If we break below this, below the 2550 level, well, that's a different story. That means we are back in this rolling grind and possibly retest down here, which is, like I said, is a 700-point drop from here to here. Do I think we get a 700-point correction between this week? Hey, I don't know, but it's a low probability move. Can we get a 700-point correction before we ramp up into the end of the year? Possible. You have a lot of risks out there. We have tax reform risk. There's a lot of disagreements. Parts of the tax bill are fantastic. Parts of it are garbage. They're working on it. At least they're working on it. We have overseas risk. We have political risk. We have China risk. What if some bad credit numbers come out? Chinese central bank governor created a 400-point correction, 300-point correction just 10 days ago in the market by saying that he's worried about valuations and he's worried about the credit situation in China. Anything can happen. All right? But the biggest risk is always the credit risk. We are going through a minor risk on the high yield bond side. I don't want to get into it right now and explain tonight on the advanced coaching sessions what these CDOs and the CMOs and all these high yield credit markets can do to markets. Well, let me just put it in a simple way. The whole great mini depression, the 2007 to 2009 pullback in the market, which was significant, threw the economy, global economy into a major crisis, was because of the mortgage market, which caused a massive disruption in the credit markets, high yield markets, you name it. Not because stocks were overvalued. Okay, I've mentioned that before. All right, so that's really where we are with the markets right now. Very, very important when I show this chart, and I'm not going to show this chart every 15 minutes. In fact, some of you should just screenshot this and keep it like some of our real smart members do. They just screenshot my charts and leave it in a file somewhere on your desk. And you can track it. Construct it yourself. It's not that hard. So bottom line is all the trends are going higher. The 20-week moving average is here. There is a standard deviation. That means the distance it's traveled between here to there. That means we could, like I said, we could get the 174-point pullback. Don't know if it's going to happen this week, but it could happen right after as we get into the first part of December. I'm telling you right now. This is your 34-day moving average, extremely important. This is your 50-day moving average, which is extremely important. You know, guys don't want to be long if we break below these levels in a hurry. I'll tell you that, all right? But they're not going to make it that easy. Unless there's a catastrophic incident, domestically or overseas, politically or economically, then you're not going to get these type of 1,000, 1,500 point type of Dow Jones type of drops. All the lines are trending higher. The bull market is still intact. It is starting to weaken a bit. No question about it. We are starting to see the first signs of a full stochastic crossover. Okay? So I'm monitoring this. Remember, you're not running billions of dollars. You don't have the luxury to wait 2 years to see whether a short works out for you 300%. We do that in a day. So don't try to mimic a fund manager or a hedge fund guy who's got billions of dollars under his disposal and what he says all the time on TV. There are guys out there who came and told us all the way down here that this was it. There were guys who came out, and these are very smart guys, that this is it. This is the beginning of the end. Well, their beginning of the end could be 3 years. I don't know about you, but I don't have the luxury of waiting around 3 years to produce a result. That's it. Now, let's move on. That's your broader picture on the markets. This is what's happening in the markets now. This is what's making us money now. All right? Wake up time. Get the alarm going. Stop the emotional garbage. None of us can really stop it, but cut it out. Tell yourself no more excuses. No more sitting on A. You know what it means. Sitting on your butt. No more jumping on every little tick and missing out on phenomenal trades that are passing you by because you're sitting with Apple, and Apple not going anywhere right now till it burps up like $2 sometime, and you're missing out 800%, 300% type of trades on multiple stocks around you. Cut it out. Bad habits in trading is like an opiate addiction. And to get out of it, the rehab and the killing the bad habits is very tough. I know that. No, I didn't have an opiate addiction. All right. So don't worry about that stuff. All of you are afflicted. Most of you, I would say 90% of you listening to this are afflicted with a massive mental disease of constantly doing the same things. Couple of those diseases. Number one, always sticking to the same stocks. Who cares? Get into some new names that are delivering big numbers. They're numbers. You think Apple gives a hoot about you? Tim Cook is really paying your bills, your mortgage? Diversify your risk. Don't fall in love with one thing, and then when it's down, don't be afraid to take part of the losses, maybe keep a core position because markets are volatile, that could turn around. I understand that part, but don't sit with the whole thing. Take that loss, use that capital to make a quick 50, 60, 100, 200% on the other side. Net, you're up on the trade. What's the big deal? The big deal is your head. All right? So I'm not going to sit here and go through boot camp trading things I've learned the hard way myself. That's why I am where I am. We do not sit on welfare. And what trading welfare is trying to be babysat on every single thing. No. We don't do that. We are pure capitalist traders. We fight for what we eat. Seriously. All right. I do enough babysitting and hand holding. Sometimes I kid around in the chat room about that. I want to completely just come in I used to be in some trading rooms where the big shot used to come in and just mention a few things like a couple of times in the afternoon and just say, all right, guys, see you later. Everything else is out there. I feel like doing that. But you know why I don't do it? Because I enjoy engaging with my great members and followers. Great members on my chat room. So that's why I try to stay engaged. Does it become difficult sometimes when I'm trying to respond to every single thing? Sure it does. Especially simple things which some members refuse to learn on their own or notice on their own. And I'm a straight up guy. I'm a New York guy, right? Yeah, I don't like something, I just say it. I'm not going to hold it back. If I object to what you're saying as a opinion on a particular thing, well, I'll give you my opinion. Maybe your opinion is going to be right. Chances are my opinion is going to be far more righter based on my track record, based on my experience, based on the way I look at markets. All right? So let's focus on this. So this is really what's going on in the markets. This is the chart that we are going to be looking at till the end of the year, or unless something dramatic happens. Look, dramatic things have happened all the time. We have, as I mentioned in the previous broadcast, webinar, we have a double top here. There's no running away from it. That's a double top, guys. We have multiple shoulders, right? These are left shoulders. We tried to break out of the shoulder and we failed. So a bear will say, told you. Well, I'll say told you because all along the way, in between multiple stock markets, big returns. $4 calls went to 25, 26, 30 on the S&P. I don't need to remind anyone. I'm not just a big-time bull. I'm saying the bigger picture, as you saw from the previous chart that I showed on the S&P 500. We're in a bull market. Doesn't mean we're not going to get corrective phases. So this is a short-term picture. This is a 1-hour view. This goes back to the beginning of November. The glorious month of November that we have crossed now on the third final week. Well, second to final week. So this is overall, technically, classic technicals, bearish. Head, left shoulder, right shoulder, There's your head. Now, every single level of inflection where you can get into buy the SPYs or the SPX, because this is the E-minis we're looking at, SPX futures. You can basically trade off this chart. There are different patterns and stuff. I even take the time to put them down. This is a falling wedge, all right? And this is the falling wedge that I was talking about. 1 second. The falling wedge starts here. Okay? And there. That's what a falling wedge looks like. And we come to the bottom of the falling wedge and we shoot higher. We come to the bottom of the falling wedge, we shoot higher. Then this bizarre thing happened with the high yield markets and whatever happened. And that day, which was only what, last Thursday, created the most monster buying opportunity ever. And we took advantage of it. And many of you did too. So God bless you all. Tap, give yourself a little lollipop. Every time you do good, buy yourself a lollipop. Every time you do bad, slap yourself on the back of the head. Seriously. Created a massive double barrel bullish engulfing candle. Hammer reversal. Hammer reversals here. I even put that down. You should know what a hammer reversal looks like right now. This was actually a very minor hammer reversal. This was a powerful bullish engulfing that created this. And that is a inverse head and shoulder. Inverse head and shoulder, which basically just went berserk. Called it. I didn't say it was going to go all the way from up to here. I said it's going to get to the neckline first, which is this. That's your neckline, right? Look how amazingly perfect these charts are. Drawn ahead of time, ladies and gentlemen. Have to remind you guys sometimes, because some of you guys are just, are snoozing too much. So there's your neckline. And I'm showing this analogy to this. So there's your neckline. See? That's what it looks like. Massive crisis, but the things turned at 10 a.m. on the 15th, which was Wednesday. And this is where we landed up on Friday. So once you broke through the neckline, once you break through a neckline, okay, and you have to watch the reaction on the neckline, believe me, because at the neckline, we actually went up. Let me show you. We went up, boom, we hit the neckline, and we started to create a pullback. But that pullback was absorbed. That's called keeping an eye on the markets. You guys don't have to. I'm doing the hard work. You just have to interpret the chart so you can manage your trades. I would love someone, any member to step up and say, "Hey, listen, I can draw charts similar to this. In fact, better. Trust me. I'll hire you. I'll hire you because I need help. I would love somebody to construct and update the charts during the day instead of me having to do it. So if anyone's listening, anyone wants to venture forward, talk to me. And I'm sure, believe me, you guys are a lot smarter than I am. All right, you guys can pick up these things faster than anything. The fundamental difference between me and things, I'm a real fighter. I'm a real fighter. When it comes to the trading world, it comes to life, I'm a fighter. I don't give up. You have 20 bucks in your pocket, make it 2,000. Make it 20,000. All right, that's my attitude. So that's it. That is a big fundamental difference. And I'm sure many of you are like that too. In fact, better. So saying all that, the thing is that the reaction was immediate rejection, but then we see this. Then we see the money coming in, and then comes the mother of a bullish breakout, known as a breath thrust. It's like a booster rocket putting the shuttle into orbit away from Earth's gravitational pull. That's called a booster. That's known as a breath thrust or a massive engulfing bullish hammer, which started here. Pulled back, scared the living daylights out of everyone, held the previous shoulder, and said, "Okay, we'll leave all the lemmings on the dust, and we're going to move on." Then this happened. I didn't know if this is going to happen. I wanted to see the reaction here first. So most of the sells for me bought down here, okay, and down here, I obviously sold a bunch here because you don't know whether this is going to come and retest and create a double bottom. That's just the way markets work. So if you're smart, you take most of your money down here. Maybe put on a quick short. These things are happening quite fast. So sometimes I don't get a chance to put on that quick short, especially when I'm seeing and I respect the power of this bullish engulfing candle. I know billions have gone in on the short covering side that they placed their bet that the markets are going to go higher. So why should I, for a quick 2 or 3 points, lose my shirt trying to short the market because I'm a frigging genius? I am not. And you guys are far from it when it comes to technical stuff. Can you get lucky? Sure, you can get lucky. But taking profits, staying long, and buying on that another bullish hammer moving higher is a far more effective strategy than trying to scalp 2 points on the S&Ps or whatever on a short and then getting completely singed, burnt, toast. All right? So saying all that, the reaction was a pullback and then bang. The booster thrust, known as the breadth thrust, massive. Once you get that, you buy. I mean, I'm long on this turn here because it's not like a secret. I'm sharing it with all you guys. I'm putting out real-time tweets as much as I can. But if you load these charts, and you can easily replicate investing.com, it's free. All right? You can sign up for advanced coaching sessions. I'll walk you and set up the charts for you because that's how much I want to help my members. So bottom line is, you can react quicker. You don't need to wait for my tweet. You can mimic my speed and my flexibility. You can mimic the overall trades and the directional bias on the markets. So once you get that, you know the market's going to follow through. So the market followed through. And the market followed through and broke above this massive range, which was a large neckline. This was for the first neckline, the mini one. Let me just do the neckline stuff now. Okay. This was your small neckline, broke above that. See the pattern symmetry? This is your big neckline, the green one. Guess what? We blasted through it. But then we ran out of juice. My stocks didn't. Our net T's didn't. Many other our stocks didn't. The market ran out of juice a little bit. All right. So it created what we call a inverted hammer, a reversal hammer. So if you're S&P and you see me, this thing once it turned, I immediately created the downtrend line. So once you see this turn, you can go short a bit. But if you wait around for the short, it's going to, this 3-point move down here where it attempted to move up again this was all happening after hours. 1 second. This is 6 o'clock. Market open. What was the last day? We closed on the 17th, right? So this was the 17th. There, by 2 o'clock it hit it there. So you could basically just make sure that I get the dates right here. So this is the 17th. Losing track here. And this all happened on the 16th. And I told you that on my webinar before, that the push generally goes into the running into Friday. And by Friday, they're doing all kinds of pin action, monthly options expiration, all that stuff. So whichever the case, this was 2 o'clock on the 16th. The markets opened up at 9 right here. And pretty much all day, it did nothing. And this is where we are right now, right? So you got that big burst, gave you a short amount of time. And that's one thing I want to remind every single person who's listening to this. Speed and flexibility. Doesn't mean you have to be glued to the computers every 5 minutes. You can do the swing trades and sit there and not even look at the screens. But for active traders, and we have a whole bunch of them, okay, the markets will only give you short windows of big bursts. You don't get this type of massive 500% on your SPX call type of winner every day. You get them once every couple of weeks. In some cases, once every, yeah, when was the last time we got one like that? That was back on the 2nd of November. Then here, we got one on the 9th of November. Okay? This is a very big one, mind you. Okay, so I can't. The most that I can think of was this replicates. This one is starting to look like this. And then it pulls back. Then it pulls back, right? Creates a consolidation channel. You can see that right there. So I've marked all the levels that we will most probably retest. So, okay, right there, right there. What we don't want to do is completely negate this pattern and break below that 25, 62, 63 level and retest this level again. I don't think that'll be too good. Unless we retest it very quickly and bounce. Otherwise, if this level breaks, that means market's going lower. And I showed that to you on the broader charts. So this is reminding me of, just so you know, get this pen here. Watch carefully. Abroad, and all of these are lasting maybe 24 to 48 hours. All right, so it's like this. This pattern is like this. Breaks out of it. Boom, retest the highs of the market. That's where the market wants to go. Well, guess what? This pattern is doing the same thing. It started off at the same level. Instead of a double bottom hammer reversal, we have a inverse head and shoulders. Explained that before. And now we're doing this. See, consolidation channel, consolidation channel. That consolidation channel could very well retest the breakout line. Remember, this was the breakout line, which was also the neckline. Right there. Not that hard, trust me. Children, by the way, can spot these patterns a lot quicker than adults because adults' brains are full of mush. Seriously, full of clutter. Children can look at this and they could probably say, hey, this is fun, you know. Maybe I should do a children's book on technical charts. I should do it, and they'll just join the dots, and we should just follow it. I think we should do it. So bottom line is that we could retest this downtrend line. That's pretty much standard procedure. If we break that, different story. If we break this downtrend line, which is only a few points below where we closed at after hours. After hours, we're at 25.76, futures were down a little bit lower, right? Right from where we closed at 4 o'clock. So bottom line is that if we break these lines, then I will move quickly on a short trade, because that means that that we could get. I like short trades where I can get anywhere from 4 to 6 points, not 2 points. It's not worth the risk. So from here, 25.73, you could fall to 25.64, which was the lower range, right? The lower range. So that's a 9-point trade. I'll take it. It could happen very quick. Speed, flexibility. For active traders, you can't snooze. You're going to be trading SPX calls for good, solid, fat moves. You got to be watching the screen. That's it. And you'll take profits along the way, do what you need to do. There's no one single method because the markets are volatile. So there is no one single method saying, okay, I'm going to buy here and I'm just going to know it's going to go there. No, you don't know it's going to go there. So you take staggered profits on each of these big moves. Enter, and these are fast. Sometimes these trades only last about 5, 10, 15 minutes. You guys know that. People who are real traders. But good money. And all that is laid out. So this is starting to look like this. This is your short zone, but this is more looking like, this consolidation channel, which will get to the top of it, find some resistance, hopefully break out. And I think that's what will happen. And we will retest the highs. Is it possible this week? I don't know, but I think it's very possible end of the month. And that's it. All right? Because I don't want to jumble your head with all kinds of different things. I have multiple stocks that are being shown repeatedly. Couple of key points you need to take out of this weekend update. Diversify your mentality and how you look at the markets. Mental calibration is key. I try to do it every day. Okay? And mental calibration means stop looking at the same stocks all the time. Why not buy something at 40 cents that goes to $2 instead of chasing a $8 call on Priceline that goes to 16? A 40-cent call going to Lotto's going to $2 or so is 400% profits. 5-bagger, 400% in your pocket. Instead of trying to chase something for 60, 70%, and it costs so much more money. Now, if you have a lot of it, excuse my French, FU money to play with, well, go ahead and do it. But if you want to reallocate, smaller accounts especially, if you want to, I hear this, a smaller account, I can't really move. That's garbage. The only reason you can't move is because you put too much into one or two trades. You can take small calls. You can buy one contract, two contracts, add them up. One contract of SPLK, Splunk, at $2 would have delivered $1,100 to you. Forget about 10 contracts. Would have delivered $9,000 to you because it went from 2 to 11. And we rolled over and we went to the Splunks for next week, and we'll keep on rolling over as long as the stock chart permits. So please don't tell me that stuff. Earnings, do them, because you do a little basket of 5 earnings. Let's see, each of the lottos cost $1 or $2. All right. So you put, let's say, $800 in it. So let's say $200 of that basically just completely disappear, or $300. Let's say $400 of the 800 disappear, but that other 400 goes to $1,200 because bang, it moves. I don't need to remind you, our ER winners in between the little ones that are down. We had one down on the ER winner just for last, the latest one bunch that we did, and that was Williams Sonoma. So if 400, if your remainder of your 400, you put $800 in, okay? This is not hardcore math, guys. Okay, you don't need to go have a MIT degree. So 400 goes to, let's say, 1,200 to 1,600, which in cases it did with Ross Stores and SPLK. I'm not even mentioning NetEase because that's just going to make many people cry. All right? Seriously. And crying is good. So bottom line is that 400 goes to 1,200 to 1,600. Your other 400 goes to 0. All right? You have made 50 to 100% on your money based on your initial ER trading capital, a budget that you put in for the earnings trade. If you made 1,200, then you made 50%. If you made 1,600, you made 100%. What gives? But you need to do a diversified basket and buy one call each. What's with, some of you want to be big shots, always buy 20 contracts? I mean, come on. That is the most precious piece of trading wisdom that I can give you. On that note, I'll see the ACS students later on tonight at 8 p.m. Eastern Standard Time. Many of you are listening. Sign up if you really want to learn the skills. I share a lot. Everything is on my Twitter feed. Many great improvements are coming. I wish you all well because I want all of you to succeed and not quit. That is great for my business, but more importantly, it's great for everyone. Have a great weekend. God bless the USA.